follow up afterwards. So thanks again for your patience. I'm going to jump right in to see if we can move through this very quickly. Anyone who knows me knows that I like to talk about things at length, but I've got 33 pages of material to get through. So I will move quickly. If everyone looks on the screen here, we're just trying to highlight the findings that we've made. The goal, just to set an overarching goal for this, we've conducted an annual survey for some time, both in the US and globally in different regions, looking at the true cost of compliance. And it's the true cost of AML compliance, but it rolls in different aspects of financial crime compliance that are very familiar to most of the folks that are in attendance. And the goal here is we contract with an outside firm to take a representative sample and actually a very broad sample of representative institutions, in this case in Canada and the US, in order to identify opportunities and gain insights to provide greater operational lift, better compliance efficiencies, and better compliance outcomes. So importantly, the role of technology is a key piece of this. Obviously, that's a key focus of LexisNexis Risk Solutions. Our technologies are key, but we don't in this study only focus on technology. We importantly focus on the role of people, and you're going to see that as we go through results here. So the insights are designed to show what's driving cost, what new initiatives are out there, where spending is happening, the impact of those things on compliance, and the total trajectory of compliance spend, and where some challenges and opportunities exist. So let's go ahead and move to the next one. The survey was for 143 representative institutions in the US and Canada. You can see at the bottom of the page first that we divided those firms into small firms under $10 billion in total assets, or mid to large and over $10 billion in total assets. And as many of you know in this space, total assets can be a fairly flexible term here. For investment firms, we used, and asset management firms, we used assets under management. Banks, it was total assets. But this is just a broad split in order to create a more digestible survey output here. The data was collected over a period of live telephone from April to May of 2019 in direct conversation with the compliance decision makers that we contacted. Again, went to great lengths to derive a representative sample here. We used an outstanding firm to help us in this space. The folks that we targeted, very importantly, as you'll see in the upper right-hand corner of this slide, were folks that are on the KYC side, both on the process and remediation side, sanction screening and monitoring, AML transaction monitoring, compliance operations, as well as a number of other areas that would fit under the broad AML and FCC umbrella. But the compliance operations piece is key because, as many of you know, in this space, the industry has moved very decisively over the last decade from a situation where compliance operational functions were largely driven by the AML compliance function itself, by AML compliance leadership. That has shifted across most of the industry, and at least in the mid to large institutions, where compliance operations has its own unique reporting, sometimes to the first line of business. They may, in fact, have a very unique focus of both containing costs and achieving proper compliance outcomes in coordination with AML or FCC leadership, who are in constant interface with the regulators and who are overseeing to make sure that those processes are sufficient. So there's been an evolution to where more of the spend comes from that space. So importantly, we pulled that space to find people that oversee compliance operations and not just FCC or AML programs. So the key findings that we found for the US and Canada, no shocker here, the spend continues to be very high. We didn't expect it to go down significantly, but under the generalized cost compression going on in the industry, we did expect that there might be some compression. In fact, we're not seeing significant reduction in compliance spend. There's the survey respondents, and some folks that work in this space may take issue with this, but I'll explain a little further. There are definitely risks being highlighted from traditional financial institutions that are driving higher compliance burden and higher compliance costs from non-traditional sources like non-bank payment providers, payment processors, online lenders, crowd lending, micro lending, and reg tech activities that are also driving change in the space. That, just so you know up front, that's not to mean that there are not extraordinarily compliant and efficient entities in those spaces, but our respondents from the large institutions and mid-sized institutions highlighted that as a particular pain point. Respondents noted that technology used properly was an effective way to address these challenges, but importantly noted that human capital continues to make up a disproportionate amount of the compliance total spend. And the respondents fed back that it was the proper integration of people and technologies into properly developed and elaborated processes that gave them the most lift. And as you'll see as we go forward, it's pretty interesting. Different size institutions in different spaces have different levels of burden, and it may actually be quite the opposite of what you would expect. So moving forward, the key finding, first one, it continues to be high. So let's go into the details on that. For mid and large institutions, they have a significantly higher average annual spend. If you look at the graphs, you'll see that the average cost for under 10 billion in assets, Canada, 1.4 billion on average, 1.5 billion for the US. That's for mid to large banks. I'm sorry, for under 10 billion in asset firms surveyed. One thing we highlighted there in that little blurb at the top is that mid to large banks with 10 billion plus in assets actually average 17.1 billion. So even though the charts on the bars on the right there say that in Canada it's 14 million on average and 14.3 million on average in the US, those mid to large banks with larger size assets highlighted a larger spend on compliance. Now, when you get to the distribution and split it between labor and technology, on the right-hand side, you'll see that in Canada, 52% of those entities responded that, those entities responded that 52% of their cost was from labor. In Canada, 54% in the US was from labor. But another highlight box there below that, in the labor costs among small firms, those under 10 billion by our definition of survey, actually reported an average 61% cost of labor. And that's really insightful. That's a big difference from what's been reported at the other institutions. For technology, you can see on the right, obviously it makes up the balance of those two. And there's a slight difference between the US and Canada there, but I don't know that statistically it's a variance that's worthy of note. On balance, labor still makes up the majority of the spend. In the mid to large financial institutions, obviously they're more balkanized, they're more segregated, they have multiple compliance functions. This does increase their complexity of environment. We highlighted here that on the left-hand side of the chart there, you'll see small financial institutions. On the right, it's mid and large again. The average compliance cost increase, all right, for the ones on the left, you'll see his average compliance cost increase for the past 24 months was reported at 6% for smalls. And the average expected compliance cost increase in 2019 was expected to be 5%. So just mildly off the prior pace of the trailing 24 months. On the right-hand side, the bigger firms, a similar pattern. Trailing 24 months, 16% average cost increase. They expect their compliance cost increases in 2019 to total 11%. So there is a general attitude that costs are being contained. What will be interesting to see next year when we survey again if they achieve that goal of reduced compliance burden. Anecdotally, from the industry, we're seeing that while that drive is there to reduce costs, it's not really driving down at the level that perhaps main business entities would like to see. So we'll see what comes about with the next survey as far as the results of that. The second key finding that we brought out was that the additional risks and challenges were coming from non-traditional sources, and I already elaborated on that. So let's go forward and look at some details around that. This first one is that traditional challenges are still there. Obviously, sanction screening, a big burden, both in Canada and the US, Canada slightly ahead. Efficient resolution of output from compliance alerts. That split also very similar between the US and Canada. One thing that we wanted to point out was those boxes at the bottom. So I can move ahead pretty quickly here. If you look, and they're highlighting key challenges, among mid to large Canadian investment firms, okay, 84% identified sanction screening as key challenge versus 48% in mid to large US firms. Now, one of the things we're seeing is increasing industry pressure from regulatory and enforcement sides for investment firms to be querying every party involved in investment activities, counterparties, payees, distributions, distribution recipients, but also constituent investors in very complex investment vehicles. And what we're hearing from the industry is that screening all those entities with the frequency with which they issue those securities or investment tranches has really increased exponentially the number of entities that they screen. So that was a very interesting insight. The U.S. is still quite significant as well, but Canada seems to be suffering particular pain in that regard. In Canada, among Canadian investment firms, 65% reported regular reporting as a very significant burden. There's some unique challenges with Canada. I think most of the folks on the phone working in North America would understand this. Those in Canada certainly would, but unique requirements around reporting of politically exposed persons that are onboarded, their transactions, new demands around politically exposed person definitions, as well as the sanctions regimes that closely mirror those in the U.S. and their close connection to dollar clearing mean that they're very much tied up around regulatory reporting as well as sanctions. So KYC, remember, it continues to be a significant pain. What's interesting is the low numbers as far as difficulties in customer risk profiling. These are a significant delta between the U.S. and Canada here. In Canada, they appear to be stating that customer risk profiling and positive ID of PEPs is a lesser burden. And again, maybe that's not surprising given the more strict regulatory requirements. Instead of being a expectation or suggestion, it is an absolute demand in Canadian regulatory regimes. So they perhaps have put more into that space, but the U.S. is still claiming much greater burden around customer risk profiling and marginally more around the identification of PEPs. So moving ahead, and again, I'm moving very quickly because of our time constraints, but you can get these materials, digest them at your leisure, come back with more questions to our team on this. On this slide here, we're talking about the pressure on investment firms. And this is a people effect. So we wanted to, as part of our study, understand what is it doing to people. This is not the customer friction, which is a whole different aspect we'll address, and which many of you are familiar with. This is actually internal job satisfaction. And I think this one is very insightful. Maybe that this would be a great thing to bring back as many of you work to maintain budget and hire highly qualified individuals. It's worth pointing out that the pressures around productivity and cost containment have our respondents here reporting back average of 68% who say they're somewhat to very concerned about the job satisfaction of their compliance staff. That's a very high number. There's not a huge delta between the small, mid, and large banks or firms, but investment firms called out in particular, again, that number is astronomical. 75% of investment firms reporting that they were very concerned or somewhat to very concerned about job satisfaction of compliance staff. Again, it probably goes back to the size of the compliance operations and the increasing regulatory burdens and expectations around investment firms. So that's one to watch. The next one we point out here is around moderate to large impact, negative impact of compliance on productivity. This is more about whether people feel they can get their job done in the face of compliance demands, and the numbers are lower, but still significant, better than half. 54% on average in investment firms, again, leading the way, saying that they believe it's negatively impacting their productivity. And then the final column there on the right is the percentage that indicate moderate to large negative impact on new customer acquisition. This is where we begin to customer friction as an issue. Not so far off from what you'd expect. Again, moderate to large. We're not talking somewhat to very. This is moderate to large negative impact on new customer acquisition. 65% of total respondents saying it's negative. That's way too much friction in the environment still. So clearly, as an industry, we have a long way to go from both our operations and processes side, but also from the solutions side in providing more frictionless customer onboarding. Again, investment firms lead the way, pulling that number upward significantly by saying 71% see a really negative impact of compliance activities on customer onboarding. So moving ahead. Some of the challenges we highlighted from non-bank and the non-bank payment providers. payment processors, and others that would fall into that non-bank traditional bank space. This chart, the circle chart here, highlights the degree that non-bank providers created challenges for AML compliance over the last year. So we asked this of these firms to say, hey, do these entities create particular concern? And you'll see the not at all sits at 8%. But compensating that is that these folks who say that those entities make up a large degree of their challenges is only 4%. So there's not a lot of folks saying that it is a huge issue for them, but also very few saying that it's not at all an issue. The rest of the numbers sit to some to moderate degree. And you can see at the bottom that there's not a huge difference in the under 10 billion in assets, but once you jump to the over 10 billion in assets, the banks and the investment firms, you can see Canada is espousing particular concern around those non-bank payment providers, payment processors, and other regulated industry segments that are not traditional banks or investment firms. This is an interesting one to pick at. It's one that we're going to dive further into as a follow-up to this survey. But we'll be interested to see if this is regulatory driven. How much does the new marijuana regime bring into this? Is it U.S. demand spilling over or vice versa? So just an interesting pain point that, again, Canada highlights non-traditional banks as a much bigger compliance concern or burden. As far as the impact of those non-bank systems, payment providers, et cetera, we highlight a few boxes here that are worth jumping right to, again, in the interest of time. The first one is the increased risk of conducting correspondent banking, okay? And you'll see that those small firms said that those kind of entities presented a 64%, they had 64% of them said that the increased risk of correspondent banking was a significant concern for them. Canada is far higher than the US. Not really a big number in increased alert volumes being driven up to the big banks, nor the cost of resources, et cetera. Once you get down to cost of technology, they're saying that their technology burden grows because of those entities throwing risk at them. And the increased alerts on compliance team, that's not that much of a shocker. That those types of entities might, to institutions in the more traditional banking sense, would see greater transactional alert volumes and increased burdens. I'll just highlight some of the facts that you all know from the industry as you've seen this. As larger institutions have steadily exited riskier relationships, foreign correspondent relationships, foreign MSBs, a lot of these customers have flocked into smaller bank segments, but also downward into the non-traditional, into credit unions, although they're more traditional than most, but also moving money through payment processors and other intermediaries that are regulated upward to a bank for clearing. And they're highlighting it as a concern. So definitely worth watching. If you are in one of these boxes and you've seen this, you may have a good understanding of the reasons why. You'll note that the US in one particular spot was far out ahead of Canada, and that was the increased cost of technology investments, perhaps suggesting that in the US, the smaller firms, if you take the box on the left and combine it with the box on the right, 58% of the under 10 billion asset firms said they had to invest more in technology because of these entities throwing risk at them. And the majority of them were in the US that highlighted that particular issue. So in combination, the two say that it seems to be US technology investments being needed to match the concerns being thrown by those non-traditional entities. And bear in mind that we have a lot of folks on the call from highly professionalized, non-traditional, non-bank, traditional entities. And again, there's a lot of those that are doing an outstanding job, but I think the industry as a whole is seen as still as a point of concern. So this slide is about the challenges that come from increased screening volumes, the complexity of cases, and lack of information that's available. And the question here was, to what degree have these particular concepts been a challenge? Either a moderate to large challenge to your AML compliance operations when you're screening non-bank transactions. So if you look here, you'll see that they're saying that they generated a high volume of transactions from these non-traditional spaces, with the big amount being in the 10 billion plus asset size. The complexity of the payment chains, lack of transparency highlighted as the next biggest concern. Again, no shocker there. Any layer you introduce creates more non-transparency, and folks are actively seeking solutions and tools that will help them get to that level of transparency. In the interim, they're still throwing a lot of human capital at it. They're still sending teams out to do on-site due diligence, will always be necessary, but they're still throwing a lot of human capital in that space. Going through the rest and jumping right down to the bottom. If you look at on the right-hand side, very interestingly, those that cited difficulty in determining transaction origin or the origination, Canada, far outpacing the US and saying that that's an issue. Volume of false positive in Canada, also a significant number higher. And then at the bottom, ensuring that they're in compliance, the US saying that they have a much harder time. So while Canada says they have a harder time getting there, they're saying that they have an easier time getting them into compliance. The US is saying they're better able to determine the origin and lesser false positive volumes, but they're better able to ensure that they're in compliance. So moving on to the next one. Our next key finding is compliance technologies are being used to address these challenges, but again, there's a huge amount of human capital buried inside compliance costs. So to eliminate some of those compliance costs, the banks in the mid to large space that leverage, compliance technologies in complement to good processes and competent people, this is a comparison to, the smaller financial institution size, and it shows how they use different things. Interestingly, one of the first ones we asked was about cloud-based KYC utilities, a big buzzword in the industry. This surprised me in that it came in the mid to large institutions reporting the use of compliant or cloud-based KYC utilities. Now, we did not differentiate between external, multi-tenant, multi-institution utilities here. So in this is both multi-tenant, which is very modestly deployed in the industry right now, but also intra-bank between business division utilities that are based in the cloud, but a very large cloud acceptance. So that was a very positive thing. Just to highlight one more thing here, continued pressure around machine learning and artificial intelligence. While AI remains a big buzzword in the industry, what seems to be most appealing to the regulators is still the explainable machine learning. And you can see that the numbers on the mid to large firm size were significantly higher than the small firm size, and to the extent to which they leverage those technologies. Further breakout on the right, but one more thing I want to point out. In the market, US versus Canada, US is stating, the respondents state that they use cloud-based shared KYC repositories or utilities, almost more than double, almost treble the size of the Canadian number, 70% for US. So moving ahead, and we have a lot of complex terms in here: unstructured audio, unstructured video, text, etc. And we don't have time to go through a full explanation of those technologies, but again, you can always follow up with us on those. As far as the standards, as far as where expectations are headed in the next 5 years, I'm going to pick just a few things here. One of them that was really interesting is that there's almost universal agreement that KYC utilities in the cloud are going to be an expectation across the board, 95 to 96%. Every segment on both sides of the border. Another one I want to highlight is the AI and machine learning. Big firms saying that will be an expectation, with smaller firms saying less so. That could be a product of the more human capital invested in the smaller institutions, or it could be some other construct, but definitely worth pointing out. I'm going to go ahead and move ahead because we are definitely behind where we wanted to be at this time. As far as challenges, again, posed to screening operations in particular, we wanted to highlight here again with the same rank chart where the degree that the rise in transactions through non-bank payment providers caused larger organizations to change its screening operations or burdens upon screening operations. For moderate to large firms, 72% of Canadian firms and 44% of US firms reported either reported a moderate to large impact upon those segments. Again, not at all, a modest number of 10%, and the large degree, a small number, So the big is in the middle here. The moderate to large impact is being felt at 72% of Canadian firms and 44% of US firms. Breakdown is at the bottom there. This one has a lot of detail, so we don't have time to go through it all. But again, for your digestion later, you can take this and review it. But manpower definitely still comes into play. As far as, this one is asking actions that have already been taken in compliance organizations who has challenges with non-bank transactions. And you can see the highlighted boxes just right of center there. Canada leading the way in all three columns. 56% implemented rigorous due diligence for approving new payment providers versus 40% in the US. That's a pretty big difference. Not sure what's driving that, whether it's regulatory or whether it's the different nature of the Canadian banking environment, but a significant difference in those that say that they have implemented a rigorous due diligence process for onboarding or approving those new providers. As far as adopting real-time, learning algorithms to proactively reduce false positives, again, Canada claiming to outpace the US significantly in that regard, with 49% of respondents, in Canada saying that they had implemented that to address the non-bank transaction risk. And going back to that last number, the 59% in Canada for fintech or regtech, 68 to 78% of the mid to large Canadian firms state that they've implemented regtech or fintech solutions or technologies to address this risk. Moving ahead. So where are they headed? What's the plan? Planning to adopt technology as well as add staff. And this is an interesting balance between the two. Highlighting just a few things across here. Again, more material for you to digest later on. All the way to the right. Increased number of FTE staff in compliance operations. Canada, respondents stating 49% stating that they will take the step of increasing FTEs in AML compliance operations. That's just under half. US not far behind at 47%. That's pretty amazing considering, again, the cost pressures in the industry, a general lessening of enforcement actions, although there's been an uptick in the last several months, particularly around OFAC. The fact that there's still half firms are still saying they're going to add headcount is quite significant. The box all the way back on the left, expanded compliance screening operation hours. That one's interesting as well. And this goes to a process change and how they interface with providers. A movement away from the traditional, overnight batch and sort of coming in the day with a workload. Are they going to expand their screening operation hours? I think it goes with technology in a way, in that they're going to implement technologies that allow them to do more dynamic, ongoing screening. Significant numbers there, 47% in Canada, 43% in the US, saying that they're going to expand, and that goes right along with manpower. So moving ahead on the next slide. Finding number 4, this is a bit of a no-brainer. To, I imagine, all of the almost couple thousand attendees on the phone here, there's, taking a layered approach, properly integrating technology with people, but also I would add good process, documented, consistent, repeatable processes. Those things coming together seamlessly is what's going to give you the most lift. So the response is fleshed that out for us and confirmed our assumptions in that regard. On here, you see average hours required for onboarding, and I'm encouraging you strongly to digest this material later on. I'm sure some of you are screenshotting it right now. The materials will be available to you. Feel free to take a picture right now. Average number of hours to complete customer due diligence, simply shocking that these numbers still reside at these levels. If you look, the way it works is the segments are up and down. So domestic retail, private bank, foreign individuals, and moving all the way right to foreign corporates, all right? Going from top to bottom, it's using 4 technologies and 2 to 3, using 1 or newer. You'll notice the pain increases as you use fewer technologies and you move to more complex business account environments. So, again, we saw on prior slides, you'll see again before we close, smaller firms tend to use fewer technologies. If you're using fewer technologies and you're taking on more complex customer bases, your onboarding time is going to go up. I would suggest to you that there's two possible lessons here, and I'm not going to make any strong determinants for everybody on the phone, but I would ask you to think about this. If you're spending far below this to onboard a domestic large corporate or a foreign corporate, are you doing it to the regulator satisfaction? Are you doing it with humans or technology or a combination of both? Or are you way over this number? This may just give you a good landmark. It's not saying it's the right number, but it's a good baseline for you to estimate where your current effort is. And if you've never cycle timed this to determine the hours needed to complete onboarding due diligence or customer due diligence generally, do it, because it'll be an amazing metric. Moving ahead, obvious conclusion here, again, mixing proper technology with good processes and the right kind of people gives you lift. So this is taking some of our prior findings and layering them into here. From moving on the left from more technologies to fewer technologies, left to right, we talk about job satisfaction, negative impact on compliance productivity. The next field is negative impact on AML compliance for new customer acquisition. And finally, on the right, average percentage of AML cost increase in the past 24 months. The more technologies, it definitely, the response, and folks, these are free responses from folks that are broadly represented across the industry, conducted by an independent outside firm. Those that use more technologies, which in many cases are larger firms, are reporting that their staff, they're less concerned about their staff's job satisfaction. So the lesson there is that the right technology with the right people and process should help you boost job satisfaction. Again, a no-brainer for many folks on the phone who've been steeped in this industry, but a good thing to bring forward to folks is say, let's invest in the right technologies, right? As technologies go down, their concerns about satisfaction increase. Impacts productivity, same dynamic. Impact upon compliance for new customer acquisition, significant difference. So here's a question. If you're a small or mid-sized place with fewer technologies, or even a large one, are you using the right technologies in the right ways? Because if you're not, you're probably having significant hurdles to take on new customers. And folks, that's what drives the bottom line. So take a look at that number, see if you can use it to go forward in your request for headcount, for technology, or for efficiency studies, wherever you need it. On the right-hand side, the average percentage cost increase for the past 24 months, trailing 24 months. Interestingly, again, still significant difference between more technology to those with fewer, but overall reporting a lesser amount of increase, 16% increase in the past 24 months. But the increase was half in those that leveraged better technologies. Again, it's not just about any technologies, it's about using the right ones. And that can come from many different parts of the industry. Next page is about layered approach again, talking about how other initiatives benefit. Why are these activities going on? I can move through this quite quickly. We have only 9 minutes left. So on the left-hand side, driver in Canada, leveraging that now instead of Canada, US, we've got 3 or more technologies in red, 4+ technologies in blue. More technologies, they're saying that the driver is for regulatory compliance. Improving technology results, okay, you'll see that the more technologies they use, that's to improve business results. So they're saying they use more technologies to drive better business results. But on the left-hand side, you've got folks, they're saying they're seeking reg compliance, and they are using fewer technologies. There's probably a balance between those two that needs to be struck. And then international expansion. This one is a good number to see because, again, moving international, whether you're a small firm, payment processor, credit firm, anyone introducing business into a bank or a large bank yourself, you'd better have the right tools to support your international expansion and to support your people, or they'll be dissatisfied, as we saw on the last slide, and they'll be less efficient, as we saw on the last slide. So the benefits on the right-hand side, big lift in improved understanding of customers for those using more technologies, big lift in improved data, and improved data for other business purposes. Now here, this is where we're gonna be careful. A lot of us work day in and day out in limited use case or restricted use case data. But all of you that are experienced in this space and heavily regulated, you know how to create those firewalls, how to split the data that's used for compliance purposes, and make sure those use cases do not bleed into credit where it can't or collections where it can't. But the bottom line is that data initiatives, particularly data improvement initiatives, customer data management, data quality improvements, those things bring lift not just to compliance, but to the whole. So this is really important. If you make the case that you need better data, it should be enriching your core systems broadly, and it should be leveraged not just by compliance, but by other business lines as well. Given that we only have 7 minutes left, the next ones are going to continue to go quite fast here. As far as helping to manage cost, average compliance spend, and again, this is AML, but it's really broader into the FCC space. Average cost in U.S. dollars, one or no technologies, 8.4 million average spend, 13.6 million in for 2 or 3 technologies, and then 4 more technologies, 15.5 million in average AML compliance spend. But look at how those costs distribute. And what you'll see is that when they're using fewer technologies, they're saving on technology, but the percentage cost for labor is measurably higher. So the average cost per labor and the percentage cost for labor for fewer technologies clearly higher. And look at the staff sizes. So, if you look at the number here, the percentage cost for labor for those leveraging 1 or fewer technologies, average cost 8.4 million. Average cost of labor 4.9 million, making it 59%. Staff 35. Now, when you take a big step up in compliance technology spend, what you don't see is a commensurate jump in every other factor. Labor costs, compliance staff, they don't jump up at the same rate. And what it's indicating is that large firms generally, and those firms leveraging more technology smartly, are using staff more efficiently in combination with those technologies. Again, it's got to be the right technology. And the average cost of FTE precipitously dropping off from those firms using fewer technologies. This one is just shocking. $140,000 average per FTE US dollars per annum at those using 1 or no technologies. 78,000 those using 3 or more. So again, it's not just about going back and saying, can we buy more stuff? It's about buying the right things from the right vendors and integrating into your processes. But there is a demonstrable reduction of compliance FTE cost as you add more technologies. And remember, going back, job satisfaction up, lesser concern about staff satisfaction, more efficiency, et cetera. So the implications of all this, obviously, technology is very important. It's going to be increasingly difficult for firms to protect their reputation and avoid costly enforcement actions without taking the right steps. This one's interesting because we have a lot of folks on the phone right now on the webinar who are not from banks and not from regulated non-bank payment providers. They are actually out there on the corporate side because the corporate side is being hammered with sanctions demands and even money laundering and other demands that traditionally only fell to regulated entities. So a lot of spread there, a lot of bleed happening from the traditional bank space. But to avoid it, it's going to become it's costly to avoid it, but you do it in the methods we already discussed. Technology is critical, but I don't want to just keep talking about technology because we are a solutions and technology and data firm. I want you to make sure you read this slide here about technology is essential, but if you've got bad data, if you have ill-defined processes, if you have inconsistent processes, or if you have bad staff, no amount of technology is going to get you to where you want to be. So wrapping it there, I will go ahead and go over. I'm going to take a quick look at the queue and see what we have as far as questions. We had some questions on some earlier slides. Yep. So let me just look at what's been queued up for us. So we had a follow-up question about this slide right here as far as average cost of compliance per FTE. It was asked for an elaboration on that. Again, the survey of the firms, this was broken down. This is by combining multiple questions to create an analysis of this across those different questions. The first question is, what's your average spend? And we then took that and extrapolated with a representative sample. That's the top part. And then we asked them to break down cost for labor. That gave us, a percentage cost for labor. And then staff, direct ask. How many staff do you have? That number just gives us a simple computation into the average cost per compliance FTE. And bear in mind, in the past surveys that were done by us and others, I don't think they focus sufficiently upon non-AML program, FTE burn, FTE expense, and compliance spend. So we very expansively looked at first line of business compliance activities and compliance operations staff to make sure that they informed our information here. So we feel we have a very holistic view. It is not an exact amount. These are averages, but I think you'll find that your institution, based on these parameters, may have a very similar track for cost. And I would ask, as we get ready to wrap up, if you have never taken a look at your average cost per compliance per FTE, here's your formula right here. Get an estimate of what's being spent in the first and second lines. You may want to add a factor to the third line as well. You got to figure out the cost for labor, staff, divide it up, how much you're burning up on an FTE. And right here is a very bold demonstration that better processes, better data, and the right technology solutions are going to give you lift. So I'm going to close with that thought. I just want to thank everyone. I'll turn it back over to Kurt. Kurt,
sure,
if you
thanks, Daniel,
pick up
thanks
and close
everybody
for
for your patience while we got the session spun up. But first, before I actually turn over and deliver closing remarks, we would be delighted to continue this conversation with you at your convenience. So if you would like to hear from a solutions representative, please submit your contact details in the Q&A tab and somebody will follow up with you. But again, thank you to Daniel Wager. I really appreciate your patience during all this. But again, we would also really appreciate your feedback. So please remember to take the survey located in the course description. You need to exit out of the current window using the 3 buttons on the top left-hand side of your screen, and then you'll be redirected to the course description.